All right, welcome everyone. Welcome to the Hurley Investments presentation of Is Stock Trading Gambling? And I know this was asked by a certain individual. Yes, I'm going to be the first one to tell this individual and their family, you are smarter than I am. You guys have bigger degrees than I have. You have law degrees that put you miles above me in the education or the scope of success in the world. But my experience here is going to be backed by numbers and understanding that is going to beat typical common sense. So let me go through some things for you guys here tonight. A lot of people ask, are you investing or are you gambling? And tonight I want to go over what gambling is and how to recognize those tendencies, what investing is and how to recognize the tendencies of investing. And obviously, I'm going to go over what Hurley Investments does differently to earn great returns while protecting your investments. First off, let's start with gambling. Are you investing or gambling? Gambling refers to wagering money in a single event that has an uncertain outcome and hopes of winning money. I mean, you really can't do a whole lot of research when you're placing a bet, whether it's betting on a golf tournament. I think a lot of us think about betting in the Super Bowl. A lot of us do bet on the Super Bowl, going to a casino and doing 21 at the tables, craps, poker. Most of those, if not all of those gambling events, obviously the outcome is uncertain. There's really not a whole lot you're doing when you're going to play 21 craps or the casinos, the slot machines. It truly is a crapshoot. And one of the things that most people don't understand, gambling involves a game of chance where the odds are usually stacked against the gambler. The house wins. The house odds are stacked against you. Not saying that the stock market odds aren't stacked against you as well, because they are, but there's some things you can do different that help you out. It's interesting because when we think of gambling, I view investing as significantly different. Yes, investing is speculation. That same word can be used for gambling or investing. But investing involves a calculated risk where you should be conducting some type of due diligence before you're entering the investment. You do have the ability to look at past history. And sometimes people talk about, well, past history on bingo, past history on roulette. We're talking about factories and people and shipments and channel check checks, fundamental analysis, technical analysis, sentimental analysis. There's so much analysis that you can do. If you do the work, you give yourself or you change those odds that they can become in your favor in investing, where there's not enough work you can ever do in gambling that change those odds into your favor. Investing requires a learning curve, a methodical and systematic way to invest that has been proven by backtesting methodology. You can't backtest betting on the PGA Tour every week. You can't backtest on betting on your Super Bowl team every week. In fact, they even have the point spread that is truly stacked against you, so that your expectation is you don't want to lose very much. I like this one. Investing often has a positive expectation return, even though the return might not happen in our desired time frame. I'm going to go about expected return here in just a bit. Here's what you should be looking at to judge if you are gambling or investing in the stock market. Gambling is a game of chance. It has a high risk, high reward for one single event. You can't, you really can't when you're on some of these gambling apps. take it back, protect yourself, buy insurance. It doesn't exist. Gambling, do you have a low odds of winning or a high odds of winning? Well, Kevin, if you bet on a stock, it goes up, down, or sideways. You have a 1 out of chance of guessing right, a 2 out of chance of not guessing right. Well, that's why we use our derivatives to change the odds in our favor. In gambling, again, I've yet to hear people expect to spend a weekend in Vegas and come out ahead. Usually the answer is, I hope I break even. Your expectation is that you're going to lose money. That should not be your expectation if you're in the stock market. If you're in the stock market expecting to lose money, yes, you should be out. Gambling, huge emotional highs and lows. Stock market, obviously, you're trying to limit those highs and lows. You're trying to even them out. You don't use emotion in investing. You use emotion in gambling all the time, kissing the dice. You're lucky, good luck, rabbit's foot, right? As you're gambling, you're increasing your risks. Every bet is a risk to reward, supposedly. It's not, it's stacked against you. The funny part is when we talk about increasing risks, the less money and the less time you have to win your money back, the higher the risks when you gamble. I talk about excitement or social proofing. Social proofing. You're going there to be seen. You're going there where you brag about, I only lost 2,000. I only lost 5,000. You're there, or the loss is part of the cost basis of going to the event, staying in a casino. It's the expectation to talk about how much you lost. It's a must-win attitude. You've got to win every single time. Obviously, gambling is very time sensitive, and the problem is it's addictive in nature. I don't gamble. If I'm walking through and we're going to a casino, I literally take out what I'm going to spend, leave the wallet in the car. 99% of the time, I leave a casino pissed off. Gambling for me is not a fun event. It's not social proofing. It just shows stupidity and ignorance, is my opinion. Even though I've got friends that love a weekend in Vegas, love a weekend down in Mexico, love a weekend at the Indian reservations, it's just not for me. There's too much uncertainty. There's too much risk. There's too much anger and frustration that I am not a gambler. Stock investing can be different because there's fundamental analysis, technical analysis, sentimental analysis, economic events. It doesn't have a timetable. You can wait for forever for things to come back. Most of us can't afford to wait for forever for the tide to turn as we're on a table somewhere gambling or doing slot machines. The neat thing is investing gives you the opportunity to lower your risk if you do it right. Now, I'm going to tell you, not all investing offers you this. The type of investing that is not this, if you're in funds, if someone stuck you in a fund, you're gambling. In fact, there are gambling tendencies, day trading. If you're trading commodities, if you're trading pips or currencies, those are all news driven. There's not a fundamental methodology or strategy to win in those events. You're following lucky trends. You got to get out and book your profits, and most people don't. There are plenty of types of investing that fit gambling tendencies. Fund trading is gambling. If you're in a fund, shame on you. You're paying someone to do zero work. They take the good with the bad. They throw the spaghetti on the wall. Hopefully, the good outweighs the bad over a year. If you are in any mutual funds, if you're in a 60-40 split portfolio, you're letting someone that you're paying take away 80% of the years that are up. 80% of the time the market's up, 20% of the time it's down, especially since 2000. You're giving up 80% of those up years to put 40% of your return in a fixed income. Clients allow money managers a very low level of worth ethic. They don't do research when they stick you in funds. They have a fund manager or a sales manager that dictates what funds you need to be in. You get churned out of those funds because 93% of them don't beat the S&P 500, yet you still allow your guy to put you into those funds. I'm not saying what Hurley Investments does always beats S&P as well, but it gives you the opportunity for some great returns. Yes, the system is rigged against the investors to profit someone like me. The stock market is set up if you're in funds, you're in a 60-40 portfolio, you're day trading, pips, commodities. All those are set up for me to make money, not you. So there is a very similar pattern or tendencies to investing like you're gambling. Don't put yourself in that scenario. I follow Buffett. Buffett is who I follow. That's who I take after for finding and using my best opportunities to find undervalued stocks. I don't have billions of dollars. I don't make millions of dollars. So I don't have forever to wait for things to come back. But in Buffett's own words, the three most important words in investing are margins of safety. If you think diversification is protection, you have not done a lick of research on how to invest ever in your life. If you look at all the market crashes, there is zero diversification that protected people from those market crashes. We can even use this year. The market was down 21.3% from the highs to the lows in 2024. If you were told just to sit and wait for it to come back, your first question should be, what the hell am I doing diversifying when I lose just as much, if not more, than the stock market offers me? And what the hell am I paying someone to tell me to just hold on, it's going to come back? That's that low level work ethic. You're paying someone upwards of 1%, 2%, 3%, 2% and 20% of your profits, maybe, to tell you to just wait for it to come back. It's a terrible risk for investors with long-term horizons to measure risk by their portfolio's ratio of bonds to stocks. That was Buffett's polite way of saying, if any portion of your portfolio is in a 60-40 growth fund, growth portfolio, you're an idiot. You're giving up 80% of the years that are profitable. You're giving up and capping your portfolio by not taking advantage of 40% of your portfolio does not take advantage of the 80% of those up years. And then I love the best one from him. Diversification is protection against ignorance. It makes little sense if you know what you are doing. Yet, I'm going to dare say 99% of the money managers are ignorant by putting people in the funds so they can get a kickback, a commission, a bonus, a spiff for having X amount of dollars in a fund. Stock investing, it's not gambling because it does have an unlimited time frame for profitability. Good traders or investors take losses but win more than they lose. That has to be for an extended period of time. They have to have some method to keep losses small. The methodology that they're investing in should, in some way, shape, or form, change the probabilities from the market being ahead, from the market having the odds stacked in its favor, to changing it to the investor's favor. And again, funds don't do that. Funds, 93% of funds don't beat the S&P 500. Yet you as an investor let your money manager put you in it. Why? The funny thing is, if you think 20% returns are risky, well, our market just had back-to-back 20% returns. Did you pull your money out? Were you sad that the stock market gave you a 20% return? If that's too risky, that the market average or benchmark is too risky for you, you probably should be putting most of your money into an annuity. And I am licensed, I can do that for you. Why are you investing? Look at the reason that you're trying to make money. Are you trying to make money in a certain period of time? Is it for a car, a home, your food? Look at the reasons why you're trying to make money and see if you are pigeonholing yourself into a specific time or a specific time frame, or if you're investing like you're supposed to be, looking at a longer time frame over a period of time or having a time horizon. Have you prepared and gone through a learning curve? Have you spent money on an education? Or do you think your learning curve is looking at Morningstar to find the best ranked mutual funds that 93% of the time are not going to beat the S&P 500? Have you back tested your methodology, or do you have a trading record to pull from? If you're back testing, are you back testing without knowing the results? Here's a big one. Do you have a must-win attitude? If you have a must-win attitude, you have too much emotion in your investing, you should not be doing it because you're gambling. Does your time frame allow for the investments to become profitable? If you have too short of a time frame for your investments to become profitable, you are gambling. Are you calculating your risks, and are you calculating those risks correctly? It's all or nothing when you gamble. It doesn't have to be all or nothing if you're trading or investing. What does Hurley Investments do differently? We use the put option. We're much like Warren Buffett. We're going to use a derivative that protects its value of a stock. It actually derives its value and purpose from the stock price that's going to be associated with. Its purpose, the long put, is to protect the value of the stock ownership from loss. It gives you the right to sell a stock at a certain price for a certain period of time. It's most related to car insurance. It works in the same way that it protects a car from a loss and damage. Yes, you have a premium you pay. Yes, you might have a slight deductible, but the long put acts like car insurance. It gives a contract. It gives a contract that gives the purchaser, the person that buys it, the right to sell an underlying stock at a predetermined stock price for a predetermined period of time. At Hurley Investments, we're trying to use that when it's 80% of the time a stock's going to lose 15% or more of its value. That usually happens around earnings. The 2 weeks before earnings to the 4 weeks after. We have 6 weeks every quarter that a stock is most likely going to lose 15% or more of its value, and that's at that earnings season. Puts increase in value, the stock price goes down. In other words, it's a bearish position. Although it's often used in stock ownership, you can be purchased without it, or in Hurley Investments, we sometimes double up. We sometimes will try to make more money on the way down than a stock is losing. The neat thing is, if we can make up 10 or 20% of the move down on a 25% total movement down, The stock loses 25%, we can make up 20% of downward movement. We're going to convert that to 20% more shares of stock for you. At Hurley Investments, we dollar cost average without asking you to spend more money. A put option protects 100 shares of underlying stock. If you want to protect 500 shares, you would need to buy 5 put contracts. We also refer to this protection as a long put, and we'll discuss a little bit more on that later. How does it work? You need a brokerage account. E-Trade, TD Ameritrade, Schwab, Money Block, somewhere where you can purchase these options on a platform. It's the same option, it's the same platform that allows you to buy stocks. You select from a list of dates that the options expire and a list of strike prices. This is called an option chain. An option chain allows you to pick the date, how far out in time you want to go, and the price you want to protect your stock at. More often than not, the best price to use is the closest price to where your stock price is at. Let's use Palantir, right? If your stock's trading at 160 before its earnings, you probably want to protect that stock at 160. Well, Kevin, Palantir was like $160.32. $160 is the closest strike price that you can have that gives you the right to sell your stock at that strike price, the $160 strike price. How far out in time? It's interesting because I told you it's like a 6-week period of time, right? Options have something called time decay. You typically want to get protected a couple weeks before earnings through at least that 4 weeks after. To protect time decay, you should add 4 more weeks. You usually want protection on for somewhere between 8 to 10 weeks out into the future. There's a difference in option price, what you pay to own the option contract. If you want to protect at a much higher price, if you want to protect $10 higher than the stock is trading, you're going to pay a higher price because you're buying that extra $10, like we just talked about on Palantir. Palantir is trading at 160.32 cents, and you want the right to sell it at 170. You're going to pay dollar for dollar for that right to sell it at a higher price. Why is it so important? Well, I'm going to go through this year and why it's been so important for us in 2024. We had a big drop. Nothing like protecting Micron Technology at 155 when it comes down here and hits $84. I mean, in all honesty, that's almost a 50% drop. Imagine if in that drop, you could make up 40% of that 50% drop and get 40% more shares of stock. It doesn't always happen that way. 110 down to 83. Another 25% drop. Let's say you made up 20% of that drop. Don't forget, that's 20% of that drop on top of the 40% shares you added right over here. Let's say you didn't catch any of this movement, but you had from 104 down to $60. Another 40% drop. We're going to say you only made up 30% of that. Dropped 40%, you only made up 30% of that drop. Do your math. 40% more shares, 20% more shares, 30% more shares. All of a sudden, you have 90% more shares of stock than you did way up here at 150. Doing your math, you have your initial 100, you have 90% more. Even at 129, because you added 90% more shares of stock, you are wildly profitable. If I was to use the example of owning 1,000 shares of stock up here at 150, that's a $150,000 investment. You put a $150,000 investment somewhere here in July. By using the process of the long put, making up some of the downward movement, not all of it, missing complete sections or parts of that drop, if we were able to add 90% more shares of stock, you have 1,900 shares times $129.73. Right up here, you would be up to $246,000, even though the stock is still trading $21 cheaper than where you got in. That is what Hurley Investments is doing for its clientele. There we go. Meta. We had a huge drop in Meta this year. Basically 740 down to 480. What a great opportunity to add. I don't know. I mean, let's do the math there. Let's do 740 minus 480. 260 divided by 740. We had a 35% drop. Let's say you only added 20% more shares of stock. And we're going to go off of, well, that's not fair, but it closed at 760 today, right? If you added 20% more shares of stock, everyone else is telling you, just hold on, you'll get back to break even. Oh, you're slightly profitable, $7,000 profitable because you waited, because I made you wait. Well, at Hurley Investments, we have 20% more shares of stock. You're up 21%. We're actively doing something in these downturns in the market. Other than telling you, wait for it to come back, we're picking up more shares of stock in these big drops down. You'll notice as I was going through and toggling through a couple of these, hey, you're doing a lot of technology. Yes. Why wouldn't you be in the Magnificent Seven? Why wouldn't you be in artificial intelligence? Why do you have an investor, a money manager, putting you into funds? We've known for 3 years now, going on 3.5, 80% of the S&P profits, 90% of the NASDAQ profits have been off of 7 to 11 stocks. If we know that, why isn't your money manager putting you into those high return stocks? Oh, because we got to diversify. No, because they don't do a damn bit of work. When they don't research what's happening in the market. If that's where the returns are coming from, that's where you should be positioned in your portfolio. Pretty neat on NVIDIA. 153 the highs, all the way down to 86. Basically lost half its value. If you picked up 30% more shares of stock in July, everyone else is breaking even, you have a 30% return on NVIDIA. And as of right now, it's trading up at what, 180? What the close? Previous close. There it is. Last trade at 180 on the nose, right? Everyone else, oh, we're up $17. We're up like 12%. Well, because we picked up shares on the way down, you're 12%. we're up roughly 42%. Is it riskier? Is it risky that we're doing something to protect and make up the downward movement? Is it riskier than just buying and holding? Is it riskier than not having bonds that will only make you 4% a year, yet this one just made you 12%? I think you need to redefine what risk is, because the way the market's set up, it gives you all the risk and very little of the benefits. Well, Kevin, for crying out loud, you can only do this with high risky stocks? No. One of our greatest returns this year is on Bank of America. Yes, it started off the year down here at $43, made it up to 47, and then tanked all the way down to 30. Well, 32. There's a 35% drop, almost 40% drop in the stock. Yes, we picked up a significant amount of shares. It would be nice. It actually looks like it opened this year right around $44 and maybe 50 cents. It's trading at $45.85. Wow, whoopee, we're up year to date after seeing it lose almost 40% of its value. You're excited about being up $1.35? Hurley Investments people, we're up over 30% on the stock because we use that long put to pick up more share. We can't predict what the market's going to do, but we can actively make up some of that downward movement, convert it to more shares of stock, and give you a great return when everyone else is just having it come back to break even. That doesn't mean that some of the positions we have to leave. We left Baidu this year because Trump came in. I wouldn't be in oil or energy stocks because we're flooding the market with oil. Yes, there are some positions that thank goodness we protected because we decided to leave when we got the signals that it wouldn't be a good investment anymore. If you have any questions, give us a call, 888-287-1030. You can always email at info or support at hurleyinvestments.com. We look forward to hearing from you in the near future and seeing what we can do to help out your portfolio. Do give us a call in the near future. Appreciate you being with us here tonight. Thank you very much and have a great evening.